Today, I share our Tfsa dividend income for the month of October. Let's do this! In case you didn't watch my previous portfolio update, we had a huge change in September that has massively impacted our income. I'll link the video here if you want to check it out. But before I jump into who paid us and how much, let's take a brief look at our portfolio's dividend calendar. You probably noticed January, April, July, and October are the heavy months, and February, May, August, and November are the light months. The other months land somewhere in the middle. In October, we received dividends from the following 12 stocks. We'll go through each paycheck we received, adding up my totals along the way. Let's see where this month lands compared to the previous month before we sold off 30% of our portfolio. Our smallest dividend received was 64 cents from Vanguard's S&P 500 Index ETF, VFV. It provides basically 0% of our total dividend income after I sold off most of our shares in September. This never will provide a huge portion of our passive income for us, as it is a growth play for us and we are using it to diversify into the big US stocks we'll never own individually. I think the S&P 500 still has room to drop. Its PE average of 18.1 is still above historical averages, especially during a crash. I plan on really adding to this position moving forward. And hey guys, if you want to follow our trades live, like when we buy more VFV and comment on what you think of it, you can download Blossom Social for free and earn $5 on sign up when you use the code Mr. Financial. Just click on the link in the description box. See you guys there. Now our next dividend at $23 is our one closed-end investment fund we have, Canoe EIT Income Fund. It now provides us with 4% of our yearly dividend income. I have no intentions to add to this high-yielding income fund that has performed really well for me over the years. It has a massive MER of 2.36%, but my yield on book more than makes up for it at over 11%. Our first two paychecks brings us to $23.64. Our next pay was $71.78 from Telus Corp. They provide us with 3.9% of our yearly dividend income. Even after selling off a small portion of Telus, it still provides a big enough dividend to more than cover our cost of internet we have with them. Telus hit a new 52-week low in the middle of the month and then rose again to finish the month flat. The most recent dividend raise was a modest 3.4%. It will be reporting its earnings on November 4th. Telus has a 5-year CAGR on its dividend of 6.7% and a 5-year CAGR on its stock price of 4%, making for a good total return. Telus is more about total return than just the income compared to its brother BCE. With the sell-off we did in September, Telus is now almost equal weight with BCE. This brings our total to just under $100 after 3 paychecks at $95.42. The next paycheck was $105.14 from Algonquin Power and Utilities. About 20% less than last quarter after selling 110 shares in September just before its ex-dividend date. Still enough to drip 3 shares in our iTrade account alone. AQN provides us with 6.2% of our forward yearly dividend income. It is trading well above its 5-year average yield of 5%, which could indicate it is very undervalued right now. I really like the discount on drip shares it gives. The last dividend raise was 6%, and it has a 10% 5-year CAGR on its dividend. I still think there is much room for this renewable play to grow its dividend in the near future. And with this dipping below $14 in October, the yield ballooned to over 6.7%. So after 4 paychecks, we are at $200.56. Our next dividend received was $39.59 from a monthly payer, Pembina Pipeline Corp. It pays us 6.3% of our yearly dividend income as one of 3 in the energy sector. This stock is trading around its 5-year average yield of 5.7%. It recently raised its dividend 3.6%. It has a 5.8% 5-year CAGR on its dividend. It is still trading 14% off its 52-week high, but is still up 16% year to date. With the economy still roaring along, it looks like oil and gas continues to flow at its regular rate. Maybe the oil cycle will hold out longer than I anticipated. This 5th paycheck brings us to $240.15. Before we continue, please smash that like button to spread this video to as many DGIs out there. And we are so lucky to have started an awesome community of supportive dividend growth investors where we can discuss investing strategies and stock ideas openly. If that sounds like something you would like to be a part of, hit that subscribe button. We'd love to have you with us and hear your thoughts in the comments below. Now back to what you came for. Juicy, fat dividends. Our best performing stock, Capital Power Corp, paid us $118.90, down from the $143.45 last quarter after selling 58 shares. This represents 7% of our annual dividend income. CPX finally started to retrace with the rest of the market, down 20% in a matter of a few weeks. It is still up on the year and has a yield of 5.1%, which is below its 5-year average yield of 5.8%. This could indicate it is overvalued. The most recent dividend increase was 6% in August. That increase was a little lower than their 7% CAGR over the past 5 years. They have an annual dividend growth guidance of 6% through to 2025. After the drop in price, I'll be looking to buy back the shares I really didn't want to sell. So at the halfway point, we are at $359.05. Next, we were paid $133.20 by Tfsa Energy Corp, about $16 less than last quarter after selling 19 shares. This represents 7.8% of our annual dividend income, up from 6.5%. I love that they have grown their dividends for 21 years at a rate of 7% over the past 20. Their expected future dividend growth guidance is 3 to 5%. Its most recent dividend increase was just 3.4%. It is currently yielding 6% after hitting 6.6% in the middle of the month. This is above its 5-year average yield of 5.4%. TRP's stock price is flat on the year. I'll continue to buy more shares when the stock fits my rule of 12 again. After this big dividend payment, we hit $429.25. Next, we were paid $45.12 in distributions from Smart Centers Real Estate Investment Trust. They now provide us with 8% of our forward annual dividend income as one of 2 stocks in the real estate industry. They are trading above their 5-year average yield of 6.1% at a yield of 6.9%. This is after rising 7% from the month's lows. It is below my yield on cost, so I should be adding to this position. They haven't raised dividends for almost 3 years. They own many properties that will be densifying in the future, so there is much potential to bring back the 3% raises that they used to do in the past. They have a 5-year dividend growth rate of 2.2%, matching inflation. So after 8 paychecks, we are at $537.37. Our next paycheck was from the brother of Telus, BCE Inc. at $155.48. This represented 8.8% of our forward annual dividend income. Though this will change because I sold 73 shares after the ex-dividend date. BCE has been growing dividends for 13 straight years at a 5-year CAGR of 5.1%. BCE has underperformed compared to Telus. Its current yield of 6% is above its average yield of 5.3%, which may indicate it is undervalued right now. Its PE is above its 5-year average, which is a mixed signal, showing it may be overvalued. Like Telus, this ran up 10% from its new 52-week low in October. With our 9th dividend, we hit $692.85. For our 10th paycheck, we have our monthly financial payer, First National Financial. We received $48.96, down substantially from last month after selling 90 shares. They provide us with 8.8% of our annual dividend income without their special dividend. This stock has been rocky all October and was yielding 7.2% at one point. FN currently provides a 7% yield. With a 5-year average of 5.6%, this is technically undervalued. I am comfortable adding to this position again despite the general sentiment about the real estate market in Canada. I like to accumulate fundamentally strong companies when they're out of favor or their industry or sector is as a whole. It also has paid out 5 consecutive special dividends in December, and that's where it's going to stop. No special dividend was declared, but a small 2.1% increase was, bringing it to 20 cents a month and 10 consecutive years with a dividend increase. This is still averaging a 5-year DGR of 6.6%. Good job, First National. We now total $741.81. Our next dividend was $162.74 by Bank of Nova Scotia. This represents a massive 9.6% of our forward annual dividend income. BNS has been paying consistent dividends since 1833 and growing for 11 years until the pandemic. The most recent dividend raise was 3% after an 11.1% increase at the end of 2021. It is currently yielding 6.3%. It has a 5-year CAGR of 4.6% for its dividend and has a 5-year average yield of 4.7%, showing it may be undervalued right now. Its PE is under its 5-year average of 11.1 at 7.9, another indicator it is undervalued. The banking sector tanked with the market. but BNS especially so. It traded in the $63 range in the middle of the month. Those are 2016 prices. The only difference between now and then is the massive dividend and EPS compared to 6 years ago. Gotta love dividend growth investing. This helps us crack the $800 and $900 mark at $904.55. And now, for our largest holding, Riocan Real Estate Investment Trust. They paid us a distribution of $61.77, down slightly from last month across 3 accounts. This company provides us with a massive 10.9% of our forward yearly dividend income. It has a 5-year average dividend yield of 6.1%, which is drastically higher than the current yield of 5.2%. This is mainly due to Riocan slashing the dividend by 33% back in 2021, for those that don't know. The most recent dividend increase was 6.3% this year, or half a cent. I'll keep dripping this all I can at this great valuation, 25% below NAV of about $26. I see this as a core holding for stability and incremental growth as Riocan adds density to their properties. Let's see how they do on their next earnings report in November. Who else can't wait for it? So after 12 paychecks, our grand total is $966.32. Our top 3 dividend payments accounted for $451.42, or 47% of the $966 of dividend income for the month of October. This was almost $300 less than last quarter because of selling 30% of our portfolio in September. As we grow the portfolio, the top 3 should account for less percentage. I never want to be too dependent on any one company or stock to help my portfolio grow in the event of a dividend cut. As you can see from the breakdown, no one industry or stock dominates our dividend income. Now, a huge part of our dividend income growth are the dividend raises we receive. We had 1 dividend increase this month. This makes a nice little streak for us of 3 months after that dry spell. First National had a 2.1% dividend increase to 20 cents a share a month. They now have a decade of dividend increases. With this, we added $12.33 to our forward annual dividend income. That is equivalent of adding over $300 of cold, hard cash at a 4% yield. That's the beauty of dividend growth investing. So far this year, we've received $7,616.05 in dividends with a yield on cost of 7.33%. Our forward annual dividend income has dropped substantially from the $9,500 to $6,842 after selling off 30% of our portfolio in September. It hurts to say that. We expect our dividend income to continue to snowball as we drip and try to max out our Tfsa again next year. I think of my dividends as my little minions that work hard for me when I can't. Next month, we should be seeing some major price action, with earnings season still upon us. So hit that notification bell if you don't want to miss it. Thank you so much for watching and hitting that like button.